Our keynote speaker today is Gary Dugan, who's now going to take control of the presentation. From an investment point of view, independence is important to us. We work with a number of trusted partners in the investment space, of which Gary and his team at Purple Asset Management are one. PAM, as we've come to call them, run a model portfolio service for us from Singapore for our clients all around the world. With the emergence of COVID-19 in nearly every part of the world, there is no getting away from the fact that we're facing one of the worst economic downturns seen in the past century. With markets in turbulence, it can be difficult to know what to do to manage your investment portfolio. And in the webinar today, we will explore how the global economy is faring and discuss some of the key steps you can take to take control over your investment strategy. At this point, I'd therefore like to introduce you to Gary and ask him to take over. Gary.
Thank you very much, Julian. I'm just, oh, here we go. I'm getting into the buttons now. Welcome everyone to this presentation. I appreciate these are very emotional, difficult times on many fronts. But what I want to provide today is something of a framework to think about the world of investments. Because I think if you feel that your investments are being looked after and with good advice, that's at least one ticket in the list of things that probably you're challenged with in day-to-day life. So in terms of the agenda, we're going to look at a cycle of emotions of both economists and markets. We know that people can be very emotional and send markets down perhaps far, far further than we would normally expect. But we live in a world of human beings, not machines. The good news is, and there is good news and sometimes it's underestimated, is that governments and central bankers are working very, very hard at the moment to provide a support for the markets. So some of the extreme volatility that we saw just 6 weeks ago has abated, and we're hopeful that things may be a bit more normal, if there's such a word, as we go forward. But clearly, I think you're dialing in today to hear about where we go from here. So we'll also give you some suggestions about the way the world is going to shape up over the next 1 to 2 years. On the right-hand side there, I'm using a positive color of green. It's saying stay engaged. It's very, very easy, I think, when you see the challenges in markets that we've seen in recent times. And every newspaper you seem to pick up is still talking about slumps, recessions, depressions, and all these kind of things. And the most important thing for you to do is stay engaged with your investments. For those people who fear that they're going to lose everything and jump into cash, I've seen this so many times in my 30-odd years of experience that those people also get back into the markets at a very late stage. So yes, you've got to take the pain, but by remaining engaged, you also then, see the bottom, see the improvement, and see better returns in the future. If you run and hide away, I promise you, you won't come back until everything is fine, but markets are significantly higher. So in terms of that cycle, I mean, just to make the point that if we go through the last, since the 1970s, markets do go up and down. I know that sounds rather facetious, but it is worth reminding ourselves that markets go down and then they go back up again. The timing of that clearly is very difficult. And to give you one little anecdote that I think I may have shared with you, those of you who heard me speak before, but in 2009, I was working at Merrill Lynch. And in March of that year, we decided to tell clients that they should be buying the markets again. And I think Merrill Lynch probably had 20 or 30,000 clients, but on a similar event like we're sharing today, there were only 30 clients on the call that day. People just didn't want to hear it. So when you are right at the rock bottom, you will not be prepared to buy. That is the normal emotion. You fear that you can't lose any more money. But it is the time to remain engaged. So if you remain engaged through the cycles, you will make good money. If you absolutely need the money next week, then it's clearly a different risk profile. But the way in which we think about investment is, one is that within your diversified portfolio, there are things that are going to be holding their value, whilst the more riskier assets will clearly go up and down, and those are such as equities. We have to take the long-term view. And I think even the more negative views of them from the medical side at the moment are saying this is 1 to 2 years. Well, if it is 1 to 2 years, that's still not 5 to 10 years. And for many of you, you may not be retiring, or you may not need your cash for another 10 to 15 years. My third point is an easy one to say, but it's also very difficult to do. I think I would urge you not to look at things on a daily basis, because honestly, it is just quite frightening. We've sat here some days and we're clearly having to look at the markets every day. And they can be pretty depressing when you see markets fall 5, 7, 8%. And then we see a lot of sell orders come in, and that's just not the day to be selling. So I would encourage you, just try to hold your nerve. Try to think about maintaining a longer term view, because I say the biggest risk is losing your nerve, going into cash, and therefore never recovering some of the downside that we've seen of the recent couple of months. So what I've done here is build a picture of how to think about this cycle of the economy and financial markets, so that I'm describing the past, but I'm also giving you a picture of the way we would see about the future. So sitting with an economics hat on, I saw so many economists back in January being in denial. Remember, the first change that the IMF made to their forecast when they heard about the coronavirus was to take 0.1% off their GDP number, 0.1. And today they're telling you that it's no longer going to be a period of growth, it's going to be a period of a significant recession. We then had the panic, and I'll show you later how companies have panicked in reaction to this. And economists have panicked, because I've seen forecasts that said that the US economy is going to be down 40% in the second quarter, where now it looks more modest, 25% is more likely. The Economist is now, though, getting a little bit more positive, because the policymakers have come back on a huge scale, and we're going to see, I think, more to come as we go through the next few months. And then as we go through April, May, we've seen some of it already, the reality of damage. Companies have gone under. Some big US retailers are in Chapter 11. Boeing's had to refinance itself, and we know the woes of the airline industry. But beyond that, as we go into the end of the year, we expect economic repair. And if you think of it this way, a highly leveraged owner of a restaurant is probably going to go out of business, but the bricks and mortar restaurant will still be there the following day. And someone walks in with the cash and rebuilds the business. That is unfortunate economic cycle, but that's in reality what happens. And there is a lot of capital out there at the moment looking to buy distressed assets and looking to rebuild this global economy. Clear recovery is going to take some time. I think we've got at least a good 12 months, and that's why I say clear recovery is into the second half of next year. Now, if you look at the way in which we think about markets, it's on a different cycle. And I've just said a tactical investor, because a more strategic investor, quite frankly, sits this out until the point that they feel that their strategic asset allocation is no longer appropriate for the risks that they want to take. And asset classes will change by nature over this framework that we're seeing. So there may be a call, for example, to be a little less exposed to equities in the future, but it's certainly not going to be zero, but maybe 4 or 5 percentage points less than it has been in the past. But what a tactical investor has done is de-risk. If they knew about this in January, they would have de-risked, they would have gone substantially into government bonds. But as we go through each of these phases, we're now getting to a point where we're feeling a bit more comfortable because we have a bit more information. The policymakers are at work. And as we go through economic repair, that's when we start to rebuild our risk. So all I'm urging people to be thinking about today is there enough information here to make me feel more comfortable, a little bit more patient with the way I'm thinking about my investments, and an ability to take more of a longer term view. So let's just talk about the panic amongst the economists first. Well, part of that panic has been seen in the numbers for industrial confidence and in unemployment. So you ask anyone in business today, how do you feel, as they did in Germany on the left-hand side there? Of course, they're feeling pretty miserable. And in fact, far worse than we saw through 2007 and 2008. And on the right-hand side there, the knee-jerk reaction of companies, of course, is to lay off staff. Now, just to give you one little insight into the unemployment numbers in the United States, they are profoundly high. So we're up there to 20 million and building. But that does not mean that those people have necessarily lost their jobs. It means that they do not have work at the moment. So we think around about the reality of that number is probably that the reality is that maybe 25% of the 20 million will truly be out of work. And we hope the other 75% of those asking or making a claim for unemployment benefits today will eventually get back into work. But that's going to be one of the crucial things that we're watching as we go through the economic cycle and the data cycle through the next 6 months. The other very, very important thing that you've got to look at as an indicator of just how bad things are is in the SME sector, so small and medium-sized companies. Big companies can deal with things because they get funded in financial markets. Small companies have to go to banks, and we know that's very, very difficult, particularly in current circumstances. But the small and medium-sized enterprises are a profound percentage of GDP. As you see on the left-hand side there, even in the United States, with all of its sophistication and big business, around 45% of GDP, around 50% of employment is in small and medium-sized companies. So they have got to hang in there. They have got to be funded. They've got to be supported. Otherwise, these economies will be seeing a far darker hole than has been forecast so far. The good news is that a number of programs have been put in place around the world. The bad news, of course, at the moment is that maybe the money is not getting to some of these companies quickly enough. But this is, again, just one further indicator. So unemployment, does it come down quickly? And secondly, do a large percentage of these small and medium-sized companies stay in business? So the good news is the Fed has come riding over the hill to save us yet again. We have a longer term problem with this, but let's just take the positive today. They have committed $2.25 trillion to the US financial markets in a matter of 2 months. There was a point in time in the middle of March when we were very, very concerned that particularly in the high yield market and even amongst the investment grade, so good quality companies, that they wouldn't get access to financing going forward. That has changed with this intervention. So there's one tick there. The second tick comes from governments. Today, the support announced is as you see on the screen in front of you. So in terms of real spending that's going on, around $22 trillion spread across these very large countries in the G20 has already been committed to be spent in a matter of quarters. This is not over the next 5 years. In most cases, this is over the next 6 to 12 months. In the case of Germany, for example, 6% of GDP is being spent in the period between now and the end of the year. The other way in which governments are helping is to underwrite, guarantee, and many other measures, which basically put them in the space of being the insurer of business in the economy. And that number is $30 trillion, which across many of these countries amounts to sometimes as high as you see in the case of Italy, as much as 30% of GDP. So I think some of that support will end up be spending rather than just a guarantee. But I say, you can't say that this is a modest amount of support. This is a significant amount of support. And that's why you've seen a rebound in some of the risk assets. Let's just talk briefly about that panic and then talk about the more positive news of the recovery. The panic was to send down the equity markets 30% in the shortest period ever, as you see across the scales that you see here. So no wonder people were panicking, no wonder people were worried when you see such a scale. And even Warren Buffett has said recently that, quite frankly, we were all lost in the headlights of wondering what on earth has hit us and how do we handle this. But again, the good news is not something we're talking about the future, it's something that's happened since around the 21st of March, is that we have recovered somewhat, not entirely, and I don't think we could recover entirely, and maybe some of the recovery has gone too far, but we have recovered. So credit to the policymakers, they have stabilized markets. Now, I've got to be honest about some of the challenges, though, as we go forward, and we'll start with dividends, because for those of you who've got a sterling bias, many of the UK assets have in the past paid very high dividend yields, or bond markets have paid reasonable income yields. But we are now challenged with some very significant cuts in dividends. So for the FTSE 100, announced to date, we've had a 25% cut in dividend forecast for the current year. And similarly, for the Euro Stoxx 50, and you've seen Royal Dutch Shell cut their forecasts and HSBC. In the US market, it hasn't really happened yet. I think we're going to get past the second quarter, because at the moment companies are scrambling to understand what's going on and the impact on cash flows. So we will see, I think, even damage in the S&P 500. And the reason those dividends are going down is that corporate profit forecasts are collapsing. So even in the S&P 500 for the US equity market, the average forecast has gone down by 25% since the early days of January. And I think, again, you know, they'll be waiting for guidance for the second quarter, and those numbers could fall still further. But let's go back to that positive again of the calming in markets. One way of measuring that is the volatility of both equities and bonds. So on the left-hand side, in the two pictures you see in front of you, in the blue color is the volatility of bond markets. I mean, it doesn't really matter what the numbers mean. You can see it went up a long way and has come down, almost back to something that's relatively normal. And the picture for the equity market, again, has come down. Now, the scale there, I'm sorry, is wrong. It's, this is for the last 12 months. So let's just go back. So we've now got a picture of where we were with the economic activity we've seen, and we've seen the repair that's been put in place by central bankers. So how are we going to play out the next phases? So this economic repair and damage. Well, you know, when we choose our managers inside our portfolios, they are very, we call bottom up. They talk to companies and they get a clear idea, or try to get a clear idea, of the way in which these companies are individually handling the crisis. So within the equity portfolio, you will find that managers are actively moving around their portfolios on a daily basis, reacting to news, reacting to what they see, and also taking a view on how their companies that they've chosen in the past would handle things in the future. So there is active management already going on in there. In the ETFs, that's more difficult because clearly there's no active management. But I would just say in general terms that the risk to the downside has been mitigated by the policymakers, and our mix of managers, or a mix of products inside the portfolio through diversification, is again trying to limit the downside. We're not going to wish to change things around rapidly from here, because I think you've got to be patient. You've not got to make decisions within days. As we go through the next 2 or 3 months, it's to take in all the information that we see from policymakers and from companies, and see if there's then a need for a significant reshaping of portfolios. And so in terms of just some general comments, if you were just choosing your own securities and trading on an advised basis, I would just make the following comments about big asset classes. Government bonds, those yields may be very low, but don't give up on them, because if something goes wrong, you still need the diversification of government bonds. Remember, US bond yields today may be positive, but in Japan and the United States, they're negative. If the US goes to a negative yield, you will get a capital gain on your US treasuries. Investment grade bonds, they are absolutely, utterly underpinned by central banks. This was the easy one from them. Central banks went in, calmed the markets, but then let it get on with itself. So companies that are investment grade already have strong balance sheets and should hold up well. The central banks have just said that they shouldn't have to pay up in order to borrow more money. And even in high yield bonds, there's been some good news, but I would caution people to be very selective and don't just go and buy an ETF and buying all high yield bonds in that index. You have to be very selective, because some high yield bonds have been supported by the actions of the central bank, others won't. And some companies will, quite frankly, will go bust. So yes, there's a big yield there, but you've got to be very, very selective. Now with equities, we've just got to be patient. You know, some days you feel like, oh, why didn't we sell all our equities? And other days you go, oh, I'm glad I'm still in my equities. The truth is, between those two statements, a reasonable amount of equities will still potentially make you money over the next 12 months. The NASDAQ index, I think, is up year to date. Many of the technology companies are up year to date. So even with all the challenges we've seen, you can still make money out of equities on a tactical basis. And on a strategic view, this quite frankly is still the only asset class that's going to be giving you returns of the 5, 6, 7% level that we would hope for over the longer term. The last major asset class, emerging markets. I suggest you be patient. We have seen a little bit of a rally in recent days, but emerging markets in general were hit by the coronavirus a lot later and don't have the same tools as are available in developed countries with their central banks to go and buy bonds and provide unlimited support. They clearly need a lot of help from the IMF. So be careful on emerging markets, be careful on high yield bonds, but the other ones are still doing their stuff. And I think we would say that if you're properly diversified, we should still be able to circumnavigate, shall I say, the crisis as we go through the next 6 to 12 months. Just some longer term themes that I just want to leave on the table is these are the things that people are talking about, and these could start to influence the way that portfolios are reshaped in the future. We talked at the beginning of the year in presentations about ESG. I see an acceleration of that. And we also talked about profit, people and planet, you know, that it isn't just about making money. And if there's one challenge for equities in the future, I think is that they're going to have to pay their wage earners a bit more than their capital earners. And I think that rebalancing will be challenging for some companies. On the right-hand side, liquidity has been shown to be very important. Companies are going to be challenged. There's about the work from home, about cybersecurity, about, you know, do you really want to take all your product from China? So a lot of things that will be challenging companies in the future. And in terms of the way we think about that at the moment, these are just very simple things that we're thinking about. ESG, you know, if I'm holding today in my portfolio an ETF in the S&P 500, do I switch that into the ESG? It's a question, right? Secondly, sectors. I think healthcare here gets funded big time over the next couple of years. We've already got, in some of our mandates, an explicit bet on that healthcare sector. Maybe it needs reinforcing, and similarly in the technology area. In Asia, I think there are a lot of questions about the role of China in the future. Clearly, for many countries at the moment, they're trying to make it out as the pariah. But even very simply, you could make the statement with a lot of confidence that companies will be saying, well, how do I diversify my supply line away from China? Not completely, but maybe there are other options. So the countries that have been talked about in the past, you know, such as the Vietnams, the Indonesias, you know, the Indias coming back with a manufacturing base. These, again, could be markets that do very well with a diversification away from from China. And the work from home, again, it reinforces technology. I think we're all now know what the cloud is. We all know how to operate a Zoom or any other technology that we're using for videos. And I just wonder, I mean, I used to do the daily commute into London. You know, will the City of London still exist in this form in 10 years from now? I very much doubt it. I think people will get off the trains. There will be more people working from home, and there's a whole infrastructure that needs to be built around that. And that must be good news for some of the equities. So I just wanted to end on a more positive and colourful note, because the coronavirus, we have so many images in our minds of all the negatives about coronavirus. And I just would like to say that for Corona, for me, when I first heard it, reminded of me back in the 1960s when I was a young child waiting for the Corona man to turn up and to deliver bottles of fizzy drink that eventually ruined all my teeth. But let's just think about the presentation in a more positive way. There are challenges. I promise you we are on top of those challenges as much as we can be. There's many a question about the future, but please remain engaged in those markets. Keep committed to the markets, because on the darkest day, when things start to rebound, I promise you, you won't be engaged if you've run away. Thank you very much. Back to you, Julian.
Thank you very much, Gary. I appreciate that. We're going to get on to questions in just a moment. Before we do so, I just wanted to briefly sort of outline Fry's own investment view, which in many ways reiterates an awful lot of what Gary has just said. Looking at the short-term market trends is always very difficult. I think many investors were surprised in the size and the speed of the bounce that we saw in April, and therefore from our point of view, we always prefer to focus on the long-term trends and the long-term benefits that we can bring to our clients. Diversification is obviously very important. We've seen over the last couple of months how important it's been to have other assets in a portfolio, such as government bonds, such as gold, which has helped cushion the fall of stock markets over the past few weeks for those investors who hold a diversified portfolio. And in terms of equity markets themselves, there is plenty of research out there into long-term trends that benefit investors, whether that be value over growth, or over the last few years, growth over value, whether that be investing in smaller companies or emerging markets. And we try and take advantage of those trends through our investment partners such as Gary, but also in the portfolios that we run for clients. And that's what we will continue to do. Effectively, we would always encourage clients to look for long-term solutions to their investment needs rather than short-term solutions for their investment needs. And there's a very famous quote which is on the screen now. It's often the time that you spend in the market that dictates how well your portfolio performs, rather than trying to time the market in the short term. So we would strongly urge you all, when you talk to your advisors at Fry's, when you talk to Gary, to discuss how we're going to make money for you over the longer term, not try and make short-term gains, which is a dangerous game to be in. Now, I promised that there'll be time for some questions, and I'm very pleased that you've been, or many of you have put questions in the Q&A box. Please continue to do so, and I'll try to get through as many as possible. If I can kick off, though, by asking Gary to look a little further out, with the huge amount of fiscal and monetary stimulus being pushed into the system by central banks, you've already outlined that this is having an impact in terms of asset prices now. But if we look beyond the current crisis, what effect do you think all of that fiscal and monetary stimulus will have to asset prices, but also inflation once the immediate problems have passed?
Yeah, thank you, Julian. It's a good question. I think the best way of thinking about this is that unfortunately the coronavirus has caused a massive hole in the global economy. Best estimates at the moment is that the level of GDP in the world will drop 7 percentage points this year. So if you think about that 7 percentage points, the policies thus far are not going to fill that 7. So when people put these scare stories out there about inflation, that could kind of only happen if the amount of help being given was substantially more than the hole in the global economy. So it could be that the global economy doesn't get beaten up as much as a -7%. But I think in terms of just pure actions of policymakers at the moment, I think I would be surprised if there was inflation. Now, having said that, it's not just the amount of money being spent and the coronavirus, but what the coronavirus has done is it's broken some of the supply lines. And those supply lines of products, goods and services could remain broken in certain circumstances for some considerable time. So I think there is a risk of localized inflation. I think, for example, you would have seen in recent days people talking about a massive increase in the price of beef. There are certain things in the food supply at the moment that are just not getting to market. If you go down to my local supermarket, you can't buy flour, for example, because it's gone from the wholesale market to the retail market. So I think we could have some localized inflation. Last point I'd make is that my only fear, and I think this is the reason that people bring up the inflation thing on a more kind of academic level, is that, really, can all these policymakers keep spending and keep issuing bonds in the scale they're doing? They seem to be on a drug. And if they keep doing that beyond this crisis, let's just say they just keep wanting to keep people happy, then I think there's a more profound risk of inflation. So I suppose long answer short, in the near term, over the next 12 months, I see limited impact of a general pickup in inflation. But if policymakers keep on printing money, then I'd be more fearful over the next 5 years.
Okay, thank you. I've got a question from VJ here, which is, how actively are fund managers able to take advantage of this market correction? And how closely do you as Purple oversee this activity? With the reason being that for some investors are already fully invested, so how are they able to take advantage of the market change that we've seen?
To be honest, I mean, okay, let me just go back a bit of history. When I was managing money in 1987, you could buy the markets in the morning and sell them in the afternoon as an institutional investor. And you could buy on a Monday and you could sell by Friday. That went on for months. the financial crisis went on for months. This, quite frankly, is being concentrated into a matter of days, if not hours. So it has been absolutely, utterly hazardous to try and trade in the markets on a very active basis. Because, of course, one is you get involved in the emotion. You want confirmation immediately. So if you don't see the market go up, you can kind of panic back out, even though you've gone in. So I would say, given, even though volatility is coming down, I don't think there's a lot of money to be made safely or safely enough in trading the markets in current circumstances.
Okay, thank you. I've got a question from David here. What will be the key drivers of the speed of the recovery? Is it the discovery of a vaccine, or are there other issues?
I used to be a pharmaceutical analyst some years ago. So I take it at face value when they tell you that it's going to take 12 to 18 months to find a vaccine. I know Donald Trump would like to accelerate that process, but that wouldn't be safe. And I don't think people are going to take that kind of risk. So I'm not so sure that finding a vaccine is going to be the answer. I do think that testing and mass testing could be an answer. So, for example, today, even if they open up everyone to travel around the country, you won't be allowed to travel internationally. Countries will not want a kind of plane loads of virus-affected people to come into their countries. So how can you make sure that when a person gets on a plane and lands in your country, that they're safe? It's the ability to test. So I think if we were to get mass testing, then I think we could almost go back to 80 or 90% of the freedom that we would ordinarily be used to. So I think that's the one thing that could help. The second thing could help. The reason that we're all locked up at home, and you go, well, it's not that many people have passed away. Quite frankly, there's not that many people got affected in the grander scheme of things. The problem is, if the numbers were to go up any higher, healthcare systems get massively overwhelmed. So if they were able to find a drug that mitigated some of the worst effects of this virus, again, that will be helpful. So if you said to me, what's the one thing that would help modestly? It's finding that drug. Second thing that would help significantly is mass testing. But I think a final solution of finding a vaccine, even if you find that vaccine, the ability to go and vaccinate everyone tomorrow is just not going to be there. It's going to take another 12 months for everyone to be vaccinated. So we are in a period of 2 years here of somewhat of a hold on our lives.
Okay, thank you. Question from Chris. Growth companies have continued their strong performance compared to value companies over the past few years. Do you see a re-emergence of value companies in the future?
Good question, because I've been trying to resolve that one myself this morning. In building portfolios, you say, well, do I just stick with growth, or is there a space for value? I think there's a space for value, but only tactically. Many of those value companies, or value sectors, should I say, have got trouble. I mean, if you look at autos, airlines, steel companies, many of those don't have an ESG angle, right? These are the kind of things that the kind of industries we shouldn't be in longer term. So they're in a kind of natural decline. Having said that, if you are the most efficient auto manufacturer, and of course, if you're going into something greener, which is electric cars, you will be seen as a growth company. But I think in general, you've got to be very, very, very selective in that area of the market which is more cyclical. I do think that a rebound in cyclical growth is going to help those value companies, and you could see quite a dramatic improvement in share prices. I'm not sure the timing is on us at the moment, but I do think that if you actually look at the main body of the growth sector, a lot of them have got strong balance sheets, and I think their growth is underpinned by what they naturally do. They're not dependent on GDP growth. And I think, I've said many times before that I think long-term GDP growth is very much challenged. So I would maintain a bias to growth sectors, but I think there is a tactical opportunity in the coming months in the more depressed sectors of cyclicals and value, but it's not a sector that I would build my wealth on for the longer term.
Okay. I've got a question from Jonathan. How safe is cash at the moment? Are we likely to see banks fail as they did in 2007-8?
I don't think it'll be on the same scale, but I do think there's going to be some consequences for some banks. And maybe this will be principally in the emerging countries where the central bank doesn't have the scope to support. I still worry about Europe. The ECB is a very political organization. It has moved very slowly to start with, then a bit quicker, and then it's getting a little bit more politicized with some pushback from German courts yesterday, for example, just to compromise a little bit of what they can do. So I say in general, we're not going to, I don't believe we're going to have a financial crisis. The only part of the financial sector I'm a little bit worried about, and we don't hear too much about, is insurance companies, because some of the risks that they've underwritten here, it's not just catastrophic, it's off the charts. So I think there could be a lot of damage to some insurance company balance sheets. So I think you've got to be careful in that sector, but not as markedly as it was in the financial crisis in banking.
Okay, thank you. I've got another question. In the portfolios you run, how have the asset allocations changed year to date? Have you remained aligned with your strategic asset allocation, or has the movement in the markets provided opportunities to be more tactical, and what have been the results?
Yeah, so if you go back to the beginning of the year, broadly, we were risk on. Our arguments at the time and the presentations I made with the Fry Group said that, you know, we had central bankers pushing money into the economy, very low interest rates, and growth was good. Of course, that all ended on, you know, in a matter of a couple of months. What we did was we then took, I would say we put protection on the portfolios by moving our asset allocation tactically towards cash and bonds. More recently, we moderated that by taking some of the cash that we'd put on deposit for a month or so and moved it back into the bond market, because clearly we felt that the bond markets, at least in the developed world, were now underpinned by the central bankers. At this point in time, I would say we're not massively risk off. We're moderately risk off, which means that generally, against our strategic asset allocation, we are underweight equities and longer of bonds. And within bonds, we're in higher quality bonds and less in the high yield and emerging market area.
Okay. I've got a question here. What risks are there from oil prices? Will big oil companies come back to the dividend list? And if so, when?
Yeah, it's a good question. I used to work in the Middle East. I know the emotion that goes into OPEC, and sadly, you know, they picked a wrong time to have a fight with the world. And that gave us an extremely low oil price. I get the sense that we're beyond the worst, only because OPEC has put some, OPEC came round to the way of thinking that they had to cut production, and they did. And those production cuts have kicked in the last few days. And it's had an immediate impact. Now, it could be more sentiment than reality, but I do sense that at least some capacity has been taken out of the market. Now, what do you do with the equities? I'm not so sure that Shell or any of the others that are now forced to cut dividends will have the ability to rebuild them back to where they were at the beginning of this year. I've said for some years, and quite frankly got into trouble in the Middle East a little bit for suggesting that, you know, there was no way that the oil price could stay above $50 over the next 5 to 10 years. So if you have in mind that the oil price will be in a range of $30 to $40, for example, Shell, in fact, most of the US majors need $60 in order to meet their previous dividend commitment. We're not going back to $60. So I think in a $30 to $40 level, you should be concerned that maybe some of those oil companies will have to cut further quarterly dividends, and that there will be no significant rebound from those levels. Remember, if they really thought that dividends were going to be, they were able to maintain the dividends in the future, they would have cut them more modestly. They haven't. They're quite frankly, they're almost passing on the dividends at the moment. They are trying to conserve cash because they just can't afford the dividends that they used to pay.
Okay, thank you. We've had a few questions about whether or not there's going to be a second dip in the market. So one of them in particular, Andrew, has asked, what is the likelihood of a retest of the market lows?
Yeah, good one. I think, you know, if you asked me about a month ago, I would have said yes, absolutely. My thought this time is that probably we go about halfway back to those lows. So, okay, the caveat to that, and the crucial question, of course, is that, you know, most of the models that you see of what's happening tell you there's going to be a second round of infections. and that's, and that might take the markets down. Clearly, we'd be in a better place at that point in time because we would, in a sense, know how to handle it. And most of us would already have kind of got wise, okay, well, this happens and that happens. Whereas last time round, it was pure panic. So I'd be surprised if we get another massive panic session like we saw last time in March, because policymakers have already supplied help to the markets, and we know how to handle it, and we know what's to come. So, but that's not to say that we won't have a double dip here. I do think we will. I think risk assets will sell off again, but I'd be surprised, and I'm hopeful that we don't get down to those lows.
Okay. And how do you see the performance of small cap investments, small cap companies versus large cap companies through this recovery?
Yeah, it's another good one. In fact, on some other mandates we ran, they actually had almost 100% cash. But in fact, there was one asset we were buying in the equity world at the moment. It was small cap, largely because of the massive underperformance versus the large cap. And in some cases, we're down to 15-year relative lows. So I think the bad news is very heavily discounted in small cap companies. However, I would stress that I wouldn't go around buying individual names, because I think you really don't know at this stage who's going to be a winner and who's going to be a loser. Even companies that have got strong balance sheets going into this are severely tested by what's happened. So yeah, if you're a trader, I would say I think there's maybe a relative bet to be taken on small cap companies, but I would prefer to wait. I would say for most of our portfolios, we're going to sit and wait. We're going to probably wait 3 or 4 months before we would think about entering again back into the small cap arena.
Okay, thank you. Had quite a few questions about gold. Can you talk about your current view on gold and the current price and where you see that going?
Yeah, so we've been hanging around 1700. We could do another 1-hour call on the problems with the gold market, of how it's manipulated and many other factors. But I would say, look, bottom line is I think the price is going to at least $2,000 over the next 1 to 2 years. You saw the picture I showed there of the Federal Reserve's balance sheet. Remember, the Fed in 2008, 9, 10 said they were going to give an emergency support to the financial markets. That emergency support stayed there, was then built up even higher, even though we were having a stonking recovery, right? That's what Donald Trump told us. But what was happening is Donald Trump was borrowing money from the Fed, and the Fed was printing the money. So you cannot have central bank balance sheets on this scale and not create a problem for you in the future. At the moment, the credibility of the US dollar is just about okay. I think the day that people say, no, look, I really don't trust these central bankers anymore, then gold just goes higher, like $10 a day for a year. So I was, in our portfolio construction today, we believe that gold's an important asset, because the medicine we're getting at the moment is not good economics, but we're going to enjoy it because there's nothing else that we can do. But that medicine will have a consequence, and I think the consequence in the future will be a lack of credibility of currencies, and the only currency you would want to hold is gold. So please stay committed to gold.
A question from Joe. Trump keeps poking China. What is the risk to market stability and destabilizing the recovery?
Yeah, that's another good one. It's a problem, in a sense that, well, maybe that problem's only here until November, December time. I mean, let's hope in some respects. But yeah, if he keeps poking this, accidents happen. And, the problem is we've just come off a decade of mass globalization, which was beneficial for global growth. Much of that disappeared, or a lot of that disappeared through much of last year as Donald Trump went around with these new trade deals with different countries and trade embargoes and all sorts of things. And now he seems to be stoking it again. I think he's stoking it just purely because he's being very, very political, because it resonates, he thinks, with the electorate to kick China. I would say, obviously we're talking more to an Asian audience here than in the UK, but for an Asian audience, I think we recognize that China's dominance is being challenged by what Trump's saying, and I think most people pragmatically will want to balance the countries that they work with to a better degree than it has been in the past. It's been almost a one-way bet on China because China was the solution. So that will do some damage to China. But I do think that offsetting the rhetoric you get from Donald Trump, there are other countries that want to engage. So I think China does okay. I think it's going to be a bit of a question mark over its future growth because a lot of countries are just going to take one step back, maybe a significant one. But I don't think the rhetoric out of the United States will continue to such a degree of damage as we've seen over the last couple of years.
Okay, thank you. The one other topic we have an awful lot of questions about is Brexit. So can you talk about Brexit risk to the UK equity market and the global economy on top of what are, some really quite awful COVID numbers, particularly in the UK?
Yeah, the UK was one of our bets for the year, and the wheels really came off with the COVID thing, and clearly the sterling was damaged as well. In terms of the Brexit, I think in a sense the UK needs a lot of stimulus from government and from central bank in order to help it through Brexit. Before the coronavirus, people go, well, really, do you want to spend that amount of money? Really, do you want the central bank to do this, that, or the other? Do you really want the central bank to act like the Fed? And now people will go, well, yes, absolutely we do. So the UK government's already cutting taxes and increasing spending. It just will continue with that program. The central bank that maybe was thinking about increasing interest rates is going to anchor them at as close to zero as possible. So I think we're going to have a lot of policy flexibility to see the UK through that Brexit moment. And I think the Europeans, quite frankly, will have to acquiesce in some manner to make this a negotiated agreement and not where the UK drops out at the end of the year. The last point I'd make is that when I talk to international investors, they are more worried about a Europe that's got all the constraints and a universal currency than they are about the UK. The UK at 123, 122 is very competitive. The UK with tax cuts and spending increases and low interest rates, again, is likely to recover. But in Italy, constrained by how much the government can spend, a Spain that's constrained by what the government can spend, the German politicians saying the ECB is not doing the right thing. The relative judgment is easy, that I think sterling should recover, the equity market should recover, but it's a relative judgment against Europe and not necessarily against the whole world.
Okay, thank you, Gary. I'm going to finish with a really difficult question, I'm afraid. Can you look into your crystal ball for a moment? For a growth-focused investor who invests in the portfolios you run, what type of annualized return could they expect to see over the coming years? I would say, okay, I'm thinking of numbers around 6-7%. And the problem is that even a growth portfolio is going to need to have some fixed income, and fixed income today is yielding close to zero. But you need that as an anchor of some risk diversification. My only caveat to quoting numbers is at the moment, most of the growth you would see is either in growth stocks, which are relatively highly valued now because they've run strongly, and the emerging markets. The emerging markets are down and kind of out for the moment. So we can't rush in and invest in things that would ordinarily give us the higher returns at a comfortable level of risk. At the moment, there's not much, it's very opaque as to how much return you're going to get from emerging countries and how much risk you're taking. So, if you ask me that question a year from now, I hope it's still that actually we're going to see 7 or 8%. But at this point, I have to reduce my numbers just because the main vehicles for adding a lot of value to capital growth strategies, they really are in a little bit of trouble, or they're not particularly easy for us to judge at this point in time. Okay, Gary, thank you very much indeed. If we didn't get to your question, I do apologise. We have a copy of the questions and we will aim to follow up on as many as we can following on from this session. We hope you've enjoyed the session with Gary. If you have any feedback or specific questions about your circumstances that weren't covered today, please do get in touch with us. We'd be delighted to help. And that just leaves me to say thank you to Gary. Thank you to everybody who's joined this webinar. And please do look out for more webinar invitations from us in the future. We've got more coming in tax and investment subjects in the coming weeks, and we look forward to seeing you again soon. Thank you very much.